Hey guys, this is Pablo, and today we're breaking down one of the most important tools for any investor valuation metrics for stock analysis. These are the metrics that tell you if a company is actually worth investing in, or if everyone else is just blindly throwing money at it. Whether you're looking to pick your next winning stock or just better understand the market in general, these metrics provide critical insights. Okay, let's do this. Look, valuation metrics are the backbone of smart investing. These metrics help you determine whether a stock is undervalued, fairly valued, or completely overpriced. Think of valuation metrics as the compass guiding your investment decisions. Imagine you're shopping for a car. You wouldn't pay a luxury price for a Toyota Camry, right? The same principle applies to stocks. Valuation metrics ensure you're not overpaying for a company's performance or future potential. They give you that edge in the market, allowing you to make informed decisions based on data and analysis. Understanding valuation metrics empowers you to make smarter decisions with your money. It's the difference between blindly throwing darts at a stock board and actually knowing what you're doing. So, are you ready to ditch the casino and step into the world of informed investing? Keep watching. We're talking about potentially retiring early here, people. Let's kick things off with the price to earnings ratio, or PE ratio. This metric tells you how much investors are willing to pay for each dollar of earnings. If a company has a PE ratio of 20, investors pay $20 for every dollar of profit. But don't look at it in isolation. Compare it to historical averages and industry peers. Is it higher or lower than competitors? Why? Assess its relation to the overall market. A high PE ratio could mean expected growth. Start researching PE ratios today. You might find your next big winner. Now, let's talk about the price to sales ratio, or PS ratio. This metric measures the price of a company's stock relative to its revenue. It's especially useful for companies with low or negative earnings, like startups or businesses in those early growth phases. Think about it. If a company isn't profitable yet, you can't use the PE ratio, right? That's where the PS ratio comes in handy. Take the tech boom as an example. Many early stage tech companies weren't profitable yet, but their PS ratios helped investors gauge their revenue potential. Investors saw that these companies were generating massive revenue growth, even if they weren't profitable on paper yet. The PS ratio allows you to see beyond the current earnings and into the potential of a company. Think about investing in the next big thing, even before profitability kicks in. Compare PS ratios within industries to identify high potential companies that aren't yet profitable, but are driving strong revenue growth. These are the companies that could be the next Amazon or Tesla. Remember, the PS ratio isn't a magic bullet. You still need to do your due diligence, but it's a powerful tool that can help you identify those hidden gems that other investors might be overlooking. All right, let's move on to the price to book ratio, or PB ratio. This metric compares a company's market value to its book value, which is the company's net assets. In other words, it tells you how much investors are willing to pay for each dollar of a company's assets. This metric is particularly effective for asset-heavy industries like banking, manufacturing, and real estate. Think about it. Companies in these industries have a lot of tangible assets on their balance sheets. For instance, during market downturns, companies with a low PB ratio often signal undervalued opportunities. This is because the market is undervaluing the company's assets. Imagine discovering a stock trading below its book value. and watching the market recognize its true worth. Use the PB ratio to evaluate companies with significant physical assets. Look for those trading below their book value for potential bargains. But remember, like any other metric, the PB ratio shouldn't be used in isolation. Now, let's talk about the PEG ratio. This metric takes the PE ratio a step further by incorporating growth into the equation. Why is this important? Because a company's growth potential is a major factor in determining its future value. A PEG ratio below 1 is often considered a sign that a stock is undervalued relative to its growth potential. This means that the market isn't fully pricing in the company's expected earnings growth. Think of a company like Netflix in its early streaming days. Its PE ratio was sky high, but its PEG ratio showed that its rapid growth justified the valuation. Investors who understood the PEG ratio saw that Netflix was more than just an overvalued company. It was a growth machine. The PEG ratio helps you balance both growth and value. Look for stocks with a PEG ratio under 1. They often signal a combination of value and growth. These are the companies that have the potential to generate market-beating returns over the long term. Remember, no single metric is perfect. You should always use the PEG ratio in conjunction with other valuation metrics. But by understanding the PEG ratio, you can gain a deeper understanding of a company's value and its potential for future growth. Okay, now it's time to dive into a more advanced metric, the enterprise value to EBITDA ratio, or EV/EBITDA for short. The EV/EBITDA ratio is a powerful tool because it considers a company's debt and cash alongside its earnings. This gives you a more complete picture of a company's financial health. The EV/EBITDA ratio is often used for comparing companies across industries. This is because it normalizes for differences in capital structure and tax rates, allowing you to make apples-to-apples comparisons. For example, utility companies with high debt levels often have a lower EV/EBITDA ratio, reflecting their stable but slow growth. On the other hand, tech companies with little debt and high growth potential often have higher EV/EBITDA ratios. Picture yourself confidently comparing companies across sectors, knowing you've accounted for debt and cash flow. Use the EV/EBITDA ratio to compare companies in the same industry. Look for those with lower ratios and strong fundamentals. These companies are often undervalued by the market and have the potential to generate significant returns. Remember, the EV/EBITDA ratio is just one piece of the puzzle. You should always use it in conjunction with other valuation metrics. But by understanding the EV/EBITDA ratio, you can gain a more comprehensive understanding of a company's value and its potential for future growth. Now, here's the important part. Valuation metrics aren't just numbers. They're tools that, when used together, tell a more complete story about a company. But remember, no single metric should make or break your decision. You wouldn't buy a house based on its square footage alone, right? You'd consider the location, the condition, and other factors. For example, during the 2020 pandemic, some companies had low PE ratios because of temporary declines in earnings. Now, on the surface, this might have looked like a screaming buy, but in reality, it was a trap. These companies were facing unprecedented challenges, and their low PE ratios didn't tell the whole story. In these cases, combining metrics like PE, PEG, and EV/EBITDA can provide a clearer picture. By looking at multiple metrics, you can get a more holistic view of a company's value and its potential for future growth. The best investors use a toolbox of metrics, not just one. With the right combination, you can make decisions with confidence. When analyzing a stock, combine at least 2 or 3 valuation metrics to get a more complete view. Look for patterns and trends in the data. Use valuation metrics to guide your decisions, but don't be afraid to use your own judgment as well. Now, let's tackle some of the most frequently asked questions about valuation metrics. First up, what is the price to earnings (PE) ratio, and why is it important? The PE ratio is like the price tag on a stock. It tells you how much you're paying for every dollar of earnings. A high PE could mean the stock is overvalued, while a low PE could mean it's undervalued. Next, how does the price to book PB ratio help evaluate a stock? It compares the stock price to the value of the company's assets. What is enterprise value, EV? It considers a company's debt, giving a more complete picture of its total value. Why is free cash flow, FCF, important? It's the cash a company has left after paying for its operations and capital expenditures. Every great investor started with questions. The more you understand, the more confident you'll feel about your decisions. So keep learning, keep asking questions, and keep pushing yourself to become a better investor. Valuation metrics are your roadmap to making smarter, more informed investments. Whether it's the PE ratio, PB ratio, or EV/EBITDA, each metric offers a unique lens for understanding a company's value and its potential for future growth. Remember, every number tells a story. The more you dig into these metrics, the closer you'll get to uncovering hidden gems in the market and potentially making those life-changing gains. Which valuation metric will you use first? Let me know in the comments below. If you found this video helpful, like, subscribe, and share it with someone ready to step up their investment game. Thanks for watching, and I'll see you in the next video.